Are you guys enjoying this market right now? No? That's okay, me neither. Sometimes it feels like Putin's attack against Ukraine is like a personal attack against me, or my investments really. But let's go over this week's research from Macro Ops and you'll see that actually Putin doesn't have much to do with it. As usual, the news just attributes the biggest event to the stock market, which is not always the case. I mean, obviously the whole Russia situation isn't good, but the more you learn about macro, the more you realize that there's already underlying conditions in the market, which is why the price is acting the way it is. Price isn't moving like this just because of some geopolitical event. So let's jump into this research and see what's actually going on. First, we could look at Bank of America's latest report, and it looks like fund managers are putting the probability of the Fed hiking in an intra-meeting in the next 3 weeks. They push that up to a 25% probability. Now, if they did that, if they called an emergency meeting and hiked rates, that would be the first time they did that since 1979. So that would be pretty crazy, but yes, it can happen. And the reason why all this is happening is because of US inflation, which is now 7.5%, which actually exceeds Mexican inflation, which is only 7.1%. That's very rare. So inflation is the problem here, as you probably already know. Now, a few measures of short-term sentiment are at consensus bearish levels. And remember, when we're evaluating sentiment, bearishness is good because more people are scared, they've pulled their money out of the market, and that means there's more fuel to go back into the market money-wise to push stocks higher. So if everybody already sold, then what's left to do other than buy? So short-term sentiment is looking bearish, which is good, but when you look at the broader positioning and sentiment in the market, there's still some ways to go before we hit a major buy signal. So you can look at the Bank of America sentiment indicators right here. You can see when it's extremely bearish, it's a buy signal, but right now we're only at about 4.2. So we haven't hit that buy signal yet. And over here, you can see that in a lot of these different components, the sentiment is still neutral. And in this final indicator, you can see that this blue line has not reached the extreme bearishness level. It still has some ways to go. So we really aren't out of the woods yet with this correction. Now, what you got to remember is that the credit markets always lead the equity markets. So you want to see what's going on here. And the rate of change in high yield spreads just hit a post-COVID high. So what really affects the stock market is not just what interest rates are, but how fast they're changing. So that's why we look at rate of change. So historically, acceleration such as this precedes greater volatility and poor forward returns over the near term. So again, high yield credit, you can see this red line right here, it's popping. So the rate of change is really flying high, highest since the COVID bear high, and that's why we're getting this type of action. So again, more than Russia, the stock market correction has to do more with interest rates. And you can see here that the S&P is forming a head and shoulders pattern, which is dangerous. This is a topping pattern. Now, what we'll likely experience for the coming weeks is chop in between these two levels. So this is the recent high and we turned around, right? And this is the low. So this is the final shoulder forming. Now, if we break this low, which maybe it's easier to see here, this low right here, so 4,300, if we break that, then we have a measured move target of 3,750, which is a long way from where we are right now. 3,750 would be another 15% down. So that would be painful, but that's what we should look out for if this lower level right here breaks. And that's why in markets like this, risk control becomes extremely important. You need to protect that downside because if you can make it out of this correction, either flat or with a small loss, you're going to do much, much better for the rest of the year when the market eventually recovers. If it recovers, because the probability is still with the bulls in the long-term bull market, but who knows what could happen. So you always want to be able to cut off that downside. And the way to do that is with proper risk control. And I know we haven't talked about this training in a long, long time, but if you want to learn how we do it at Fallible, how we make money but in a safe way so that we could always protect ourselves when markets get crazy like this, especially if a real crash comes, make sure to check out our free training. I'll put a link down below in the description and comments. But you definitely want to get a strategy like this in place, and now is the best time because this market is indeed acting crazy. So it's a good time to start using this strategy. So definitely check it out. Moving on to some individual plays that we're looking at, a number of gold miners are looking pretty good, like Barrick, which has the ticker symbol gold. It just closed above its 200-day moving average. So this is one you could definitely add to your watch list. Another sector to look at right now is energy. You can see right here, energy sector profits are way up since 2017. They're up 4 times while CapEx is down 30%. So this is very bullish and something you should keep an eye on. Energy has been the sole runner in the market race year to date. So they've been the only sector that's been doing well. But tech, healthcare, and consumer discretionary all saw saw MACD buy signals above 50% last week. So things are turning around because, especially in tech, there has been a massive bear market. A lot of companies got chopped in half. You even saw Facebook get crushed, right? So this is all setting up for a good rest of the year as long as we can clear all this out. Another company we're looking at is Lockheed Martin, ticker symbol LMT. You can see that the long-term chart looks pretty good and it looks like it's coiling up for a big move. The company is trading real cheap on a historical PE basis, and it also raised its dividend to nearly 8%, and it's been going on a share buyback spree. The board approved $6 billion in future share repurchases, which is roughly 5% of the market cap. So that's always good to push prices up. So Lockheed Martin is another one to add to your watch list. But again, more important than the upside is the downside. You got to protect it. So if you haven't already, make sure you check out our free training, which will teach you our strategy to do that. I'm going to put a link down below in the description and comments. But check that out, and I will see you in the next video.